Welcome to Show J. Peng.guo and I are particularly pleased with the topicality of our shows. People are beginning us feedback that everything seems to be linked. Well, there's a method to that because in China, and particularly what our show is about, is the link between investment and policy. And while in China, the government may not control all the means of production, they still have an outsized impact. And today in policy, we're going to be talking about that impact and how the so-called national team steps in some markets to try to moderate price. So recently, we were listening to Premier Li Keqiang, and he was saying things about the price and production of raw materials and how that needs to be stabilized a little bit. In other words, price controls. Viewers have learned, and in this previous show, we showed you how important commodities on the ground in China and in renminbi are going to be. And if we've been looking at commodity prices over the last few months, we've seen all of them ripping up and to the right. Aluminum, gold, cobalt, all of these commodities, copper included, have all been increasing rapidly. And this is a function of speculating on the one side, which is the traditional way, and now more and more hedging.
That's right. We all know the commodity price soared this year. This is probably the best year for the commodity. The most important thing is still related to the global money policy as well as the interest rate. So that is the drive for the big cycle of the commodity. So everybody knows that. But for China, they have the national team. They are the big player in the market. I think the national team, from the name, they represent the country to place the big order and execute a big order. Another important goal is to make the market stable, especially like the agricultural product. Because if the agricultural product, if the price moves so quickly, this will cause a tremendous of the social problems for the downstream small players as well as the individuals. So you probably heard that in China, the government put the stable social environment as the first place. So they pay a tremendous of the price and the resource to doing that.
When we're talking about the sovereign wealth funds or the national team, what are we talking about? There's really four funds. The first is the Social Security Fund. The second is the State Administration of Foreign Exchange. Then there's Central Huijin and China Investment Corp. These four entities are in and out of markets so much that people are watching that for the policy and for the directionality of the market. So in the past few months, when the China equity market is sold off, everybody's saying the national team is stepping in, the national team is stepping in and buying equities. As a matter of fact, the largest owner of equities in China is the state, not necessarily through these entities, but through state-owned entities as well. So the national team is now entering into equity market, entering into commodities market. They've always been in the fixed income market, and they've always been in the FX market. They're also into the policy. Remember, property, we talk about property a lot on this channel. When property prices start to accelerate too fast, the government will step in and say, okay, lending rates are going to be constrained. So this is the way that they push and pull the different aspects of the economy.
Those big names you mentioned is more like in the financial market. Long-term investor from that perspective.
Right.
So they probably purchase, especially if market get a crash or some at the pretty low, they probably get into to make the market stable. So especially like the Asia market. So most of the time, if you see the national team came into market, people just feel a little bit comfortable. Otherwise, nobody knows how low the market could be.
Yeah, it's also a little bit like the Fed in the US, right? When the Fed, I mean, the Fed doesn't buy equities, but when the Fed says they're going to go buy government bonds or they're going to buy even corporate bonds, remember, 18 months ago, the government stepped in and bought corporate bonds. So when that happens, you have a lot of anticipation and social finance trying to get behind these ideas and when they're going to get into, they're going to try to time the market. So what happens is it creates more volatility. Although the initial impetus for getting into the market is to tamp down volatility, I submit that it creates more volatility.
I don't have the data for that. But from my personal experience, really personal experience. I don't think they created the volatility. It's more like they save the market most of the time, and most of the time they like the long-term investor. They purchase it low, they hold it for a pretty long time. What does the market really watch? The money from the Shanghai, Shenzhen, Hong Kong connect. So whatever the money, they have the indicator. They track that one daily.
But those guys are small. I mean, if you look at the overall context of foreign investment into China, into the secondary market, into the equities market, it's still very small.
That's right. So this is, but they just try to get a direction of the market.
Yeah, that's true. Yeah. That's true. Well, that's the issue, right? You have a lot of retail investors, and then you have a few very large names. So when everything's selling off, people are saying, "Oh, you know, the national team's going to step in. The national team's going to step in, and that's going to really put a floor into the market." And I'm wondering how we link that back to the commodities market now. You see everything ripping. What can the government do? Well, they can increase production, they can force entities to do other types of mining, go find more copper, these kind of things. Definitely they can step in and affect policy.
Generally speaking, the high commodity price is not good because a commodity is the cost. So China is a bigger manufacturer.
Yeah, it's the input cost, right? So you have rising price of input cost. Yeah.
Yeah, they get worried. So they try to do some way to reduce the impact of the downstream big client.
What we're seeing and what we're trying to explain to our subscribers is we do have a number of things that affect price on the mainland. And if you've been listening, the commodities price in China in renminbi is very important. So today on Capital Markets, Peng and I thought we'd just give you an update of where the A-share markets moved and what some of the big names have done year to date. We're sort of more than a quarter away through the year. And what's been the performance of the A-share market? And China's been in the news a lot, particularly the China tech firms. They're all getting called in, and they may have to disinvest all of their fintech operations. And then, the G7 just met, and they're probably going to have some strongly worded letters about South China Seas and Xinjiang and Taiwan. All of our followers know all about this at this point, but where are we? What happened? So if we look at a chart of year to date for the CSI 300, and I even put up something KWeb, which is a lot of the China tech names, and I also put up CBON. We'll put up charts of everything so everybody can see, but what did we get? Well, we got a lot of volatility, and we're basically flat. Also, Maotai, Tencent, Alibaba, all flat year to date. And if you look at that CBON, which we always recommend getting a slug of China fixed income, very flat and up a few percent.
That's right. It's quite frustrated. So year to date, I just did some of calculation yesterday. I just realized like the CS 300, they probably just the year to date return like the negative 2%. So just pretty much back to the starting point. Same things for a small cap is performance a little bit better, just a few percentage. But from the realistic, so we know the PE, like the SP 500 is almost 33 right now. For the Asia market, Shanghai Composite Index is almost 14. Shenzhen Composite is almost 28. It's in the historical low price. So it's really the market that have some volatility. It's hard to get up, but it's also nobody want to sell at this time. Another very important indicator, they call the Buffett indicator, is market cap compared with GDP. From that perspective, United States is almost 200%. From China is 85%. So I just want like to see is China from the PE perspective is relatively low.
The irony here is we're talking about China as a value play and the US as the growth play.
That's right.
No. Well, we'll see how it develops. I think we have a situation where in the US we're debating this value versus growth as well. And China definitely has a number of very big names. A lot of the financial services firms are very big, very, considered value names.
Another very important difference is pretty much the trend in China is they use the focus on the real estate business. And right now it's not performance well. So they allow like the social security related insurance company or other commercial insurance company to allocate more money into the equity market.
Correct.
So that really means the equity market is high efficient, and also they allow more and more company go public in China. So the market size and the number of the company will be continue increase in the next couple of years.
Yeah, and I also think on the fixed income side, this discussion we had last week about changes in the fixed income market, more transparency in terms of bankruptcy and understanding who's going to get paid and when that's going to get paid and the timeliness of that. All of that adds to more confidence in the local market as well.
Yeah, and China is talking about like the new stock exchange, except the Shanghai and the Shenzhen.
Yeah,
that's probably for the international stock exchange. They are trying to they are figuring out right now.
Yeah, I like to hear about those things. Unfortunately, when you're on the ground running money and you have to deal with all of these new policies, the cost of compliance is very, very high for any institution that's trying to keep up with all of this.
That's right. That's why they need some expert to help out. But as long as you know how to play in the China market, probably it's not that too difficult.
In terms of international institutions, you cannot take shortcuts. Otherwise, you run very high risk of
That's right.
being out of compliance. Local guys will move fast and break things, but large institutions cannot move fast and break things, unfortunately.
That's exactly right. So I think large institutions really try to invest the sectors or companies which have a long-run bright future. So Correct. They cannot play the short-term speculations.
Well, we're going to leave it there. Thanks for tuning in this week. Please give us feedback down below. Reach out to us. Let us know if there's any questions. And we appreciate your time. And we'll look forward to seeing you again soon.
Thank you.